All right, so today we're going to tackle a fascinating company, one that's built an absolute fortress in what has to be one of the most competitive markets out there, UK kitchens. I'm talking about Howden Joinery. Now, these guys don't just lead the market, they pretty much dominate it. But from an investor's point of view, the question is always the same, right? Is this fortress really as strong as it looks? And maybe more importantly, what's the right price to pay to get inside? So let's dive in and find out.
Okay, so let's set the scene. The UK kitchen market, it is a fierce, fierce battlefield. So how in the world did one company manage to not just survive, but climb all the way to the top and become the undisputed king?
Okay, just take a look at this. The sheer scale of Howden's dominance here is, well, it's staggering. We're talking a 30% market share. That's not just a lead over the next guy, Wren Kitchens. That is a massive chasm. In a market this jam-packed with competitors, a gap like that is practically unheard of. So, you gotta ask, right? How on earth did they manage to build this empire?
And, to really appreciate that 30% number, you have to understand the battlefield itself. We're talking about a massive 11 billion pound market, but it's also incredibly fragmented. You've got the big national retailers, you've got the specialists, and then literally thousands of small, independent showrooms all fighting for a piece of the pie. For one company to grab such a huge slice in a market this splintered, well, that's just remarkable. It screams that they must have some kind of powerful secret weapon.
So what is that secret weapon? Well, it's not just one thing. It's what we investors love to talk about, a competitive moat. A set of advantages that are really, really hard for competitors to copy. And in Howden's case, it's not just a moat, it's a powerful three-layered one. All right, let's break down the secret sauce pillar by pillar. There are three key ingredients that all work together perfectly. First, they have this strict trade-only philosophy. We'll get into that. Second, a massive network of depots where everything is in stock. And third, they control their own manufacturing. So let's see exactly how these pieces fit together to create that moat.
Okay, first up, trade only. Now, this is the absolute foundation of everything. Howden will not sell a kitchen to you or me, the general public. No way. They only sell to builders. And this is genius, because by doing this, they're not competing with their customers, they're partnering with them. They give them credit, they do the design services for free, they basically become the builder's entire back office. And what does that do? It creates this incredibly deep, symbiotic, loyal relationship that a regular retail store just can't touch. It's a brilliant move.
And then you supercharge that loyalty with the second pillar, the depot network. This quote here from a trade professional, it just says it all. For a builder, time is literally money. Any delay on a job is an absolute disaster. Howden completely solves this problem. They have this massive network of local depots where everything is in stock, right now ready to go. That convenience, that reliability, that is gold to a builder. And nobody does it better than Howden.
And the third and final pillar is something called vertical integration, which is just a fancy way of saying they make a lot of their own stuff. This includes their own exclusive brand of appliances, Lamona. Now, from an investor's perspective, this is huge. Think about it. It means they have total control over quality and design. It means they get to keep the manufacturing profit that their competitors have to pay to someone else, and it gives them amazing flexibility in their supply chain. This is a massive reason why their profit margins are so darn good.
Okay, so a great business model sounds good on paper, right? But the real question is, how does it hold up when things get really tough? Well, the recent economic downturn was the ultimate trial by fire for Howden's moat. The market was just hammered by a perfect storm. You had soaring interest rates, which put the brakes on the housing market. You had the cost of living crisis, which meant people were suddenly thinking twice about big projects like a new kitchen. The whole pie was shrinking. It was just a brutal, brutal environment for anyone in the home improvement space. And look at this. The results are just so stark. While its biggest competitors saw their sales fall off a cliff and profits collapse, Magnet actually started losing money in the UK. Howden just held the line. Revenue was basically flat, and they still cranked out over £328 million in profit. This right here, this is the moat in action. This is what it looks like when a business proves just how defensive it is when it counts the most.
But honestly, this number here might be the most incredible part of the whole story. At a time when everyone else was getting squeezed by rising costs, Howden actually increased its gross margin to a record 61.6%. Just let that sink in. During a period of massive inflation, they had the power to pass on those costs and then some. That is what you call pricing power. It's proof positive that their builder customers value the service so much they're willing to pay a premium for it. And that right there is the sign of a truly exceptional business.
So all that operational strength we've been talking about, well, it's built on an incredibly solid foundation of financial health. Let's peek inside the vaults of what you can only call a financial fortress.
First off, at the end of the last fiscal year, Howden was sitting on a massive war chest, over £343 million in net cash.
And get this, what's just almost unheard of for a company this big? Zero bank debt. As an investor, seeing a balance sheet that clean is just beautiful. It is the ultimate foundation. It means they have total flexibility to survive any downturn and to invest in growth exactly when and how they want to.
So what's the game plan for all that cash? Well, management is very clear and very disciplined about it. It's a simple three-step process. Priority number 1, reinvest in the business to keep that growth engine humming. New depots, better manufacturing. Priority 2, pay a nice, steady, growing dividend back to shareholders. And priority 3, any extra cash they have kicking around gets returned to us, the shareholders, through share buybacks. It's just a really smart, shareholder-friendly way to run the show.
And the growth story isn't over, not by a long shot. They can keep grabbing more and more share in that fragmented UK market. They can push into new areas like bedrooms. And then there's the international expansion, which they're doing very carefully in places like France and Ireland. Now, yeah, growing overseas, especially in a market like France, that definitely comes with more risk. But if they get it right, it's a huge long-term opportunity.
Okay, so let's recap. We have a dominant business, a powerful moat, a fortress of a balance sheet. It all sounds pretty great. But this leads us as investors to the million-dollar question, right? Quality comes at a price, and the dilemma is, what's the right price to pay for a business this good?
Well, as you can see from this table, the market already knows Howden is a high-quality company. The secret's out. It trades at a price-to-earnings ratio of about 19. Now, to put that in perspective, that's nearly double the average for similar UK companies. So let's be clear, this is not a cheap stock in the traditional sense. You are definitely paying a premium price for that incredible track record and all those defensive qualities we just talked about.
However, that premium price doesn't tell the whole story. Look at the cash that's coming back to shareholders. When you add up the dividend yield and the money they're using for share buybacks, you get what's called a total shareholder yield of around 4.5%. Now, that is a really solid cash return on your investment, and crucially, it's backed by real, sustainable profits and that rock-solid debt-free balance sheet.
So it all boils down to this classic investor's dilemma. On the one hand, you've got this incredible business. It has a powerful moat, it's proven it can handle a tough economy, and it still has ways to grow. But on the other hand, you have that premium price tag, which suggests a lot of this good news is already baked into the stock price. Plus, it's very dependent on the UK economy, and there's still a question mark over how well the international growth plan will work out. Look, at the end of the day, there's no debating that Howden has built a true fortress. It's proven it can withstand pretty much any economic storm and just keep generating tons of cash. The business itself is exceptional. And so, for any potential investor, the entire decision really does come down to that one final question. A fortress is built to last, but what's the right price to pay to own a piece of it?